Good afternoon, Rameshji. Good afternoon. Okay. All right. How's everyone doing? Come on, give me some feedback.
Doing good, Vic. Doing good.
Hey, T, good to see you here. Good to see you. T, your volume is very low. I'm not sure if it's just me, but to me, it sounded too faint.
Having connection issues.
Yeah, this one was a little better. But fine, good to see you. Yeah, we meet every Saturday morning, 10 a.m. Pacific. And as you can see, this is 244th session. So I've been doing this for almost 4.5 years now, just to get together, meet, talk about stocks, little bit of crypto. I don't go into the details of crypto. That are, I reserve those questions for our Tuesday meeting with, with Paul. But, if anyone have a question here, I do. I'm open for discussion on crypto, but mostly we just touch upon what's happening. If there is any, major changes that have happened that week. All right, any other new name I see here? Preet? Is this the
Hello.
first time you're joining?
Yeah, this is the first time I've joined. I just saw this invite and meetup, and I thought maybe I'll hop in and see what's going on there.
Sure, welcome. So what are you interested in, taking away from this session? I just want
Talks
to...
review mostly.
Okay.
The insights which you guys might have in
Okay.
a way. I mean, I'm not sure what's the agenda, but read through this talk review and some details about the post which you had. So I thought of joining in.
Cool.
Yep.
Yeah, so agenda is generally, I start with overall on the market side and then get into some stocks, look at, if there are some news around the companies, what we can learn from the business of company. If there's
Awesome.
earnings going on, and then I will analyze some earnings. Now, earnings is almost kind of I shouldn't say earnings is over, because next week we have a granddaddy of earnings. So, but yeah, we are at the fag end of the earnings season, so not too much of earnings to discuss this week. Yeah, but yeah, that's what we focus on.
Yep, happy to be here.
Yeah, and if you have any questions around options, strategy, etc., yeah, bring those here. Bring those here. Okay. Let me see. Anyone else joining here for the first time? Oops.
Yeah, I'm new.
Sorry. Hi, Albert. How are you?
I'm doing pretty good. This is my first meeting, and I just kind of opened up, noticed that there were meetup investing groups outside of Southern California, and I go, oh, wow, Silicon Valley, they might know some good stuff. So I just thought I'd join and listen in as long as I could today.
Cool. Yeah. I mean, I also, keep searching for looking for some meetups, etc. So glad that you found us, and hopefully, you'll get something that that you can make use of, and we all will learn from your knowledge as well.
Yes, that'd be great. Thank you.
Cool. I see a comment. What's the Tuesday meeting? So Aditya, Tuesday is different one. So I attend. So over the week, I attend only 2 meetups. I think someone pinged me on Slack. Hey, what meetups do you attend? Can you suggest any meetups? So I myself attend only 2 meetups. This is the one Saturday. Then Tuesday, there is another crypto meetup. It's called Austin Crypto meetup that I attend. I've been attending that for a couple of years, and I met T over there. So that's a meeting that I was referring to. I used to do my own crypto meetup, but then I stopped doing it like 2 years ago. I just don't have time right now to run 2 meetups. It needs a lot of, I mean, you need to put in a few hours to prep for the meeting.
Yeah. No, wonderful.
Single stock options. We need more stock options. That's constant money. Only constant money that there is in crypto mining.
Yeah. Yeah,
Stick with
so
stock options.
yeah, so if anyone is interested in crypto mining stuff, he's the guy. He's like into the deep end in this pool. I don't do mining, but if you have questions around mining, etc., hit T up with your questions. Okay. All right, so T and I, we are both attend that.
Sorry, let me jump in here right quick. Who was just speaking and stated that they had meetups in Southern California?
That was Albert.
Albert, are those open meetings?
Yeah, there's all kinds. There's, 2 or 3 of them. There's one that actually meets in person and online. But it's usually people talking about their different ways of doing things, but they usually don't give out their algorithms.
Okay. No, I love to be around people like that. Do they have do you have a link to the meeting for Meetup? A direct link, because it's hard for me to search meetup.com. Whatever works best for you, or if I need to give you my contact information and you just text it to me or something like that, I don't care. Whatever works best.
The one that you can look up is OC Traders.
OC Traders.
Yeah, OC Traders as in Orange County. I don't know if it's O period, C period, space traders, but that's the name of it. And that's the one that seems to be doing the most consistent. A lot of them come and go.
Yeah, this is one thing about the meetups is I see a lot of meetups been active for a year, 2, and then you see nothing happens. I've been in person meetup, and the host never shows up. So I've been to there like twice, and then like, you know what? I'm not going.
Yeah.
All right. So cool. I think we have a quorum. So let's get started. Some more folks generally will around 25 people. Some will join a little later, so that's fine. So let's get started, guys. Welcome everyone. This is our Saturday meeting, Saturday our exercise, call it dojo, whatever, where we get together, talk about stocks, macro, little bit of company news, review the stocks, talk little. I'm a big fan of right mindset for investing. So sometimes I do drop in the content which is more related to just an education, building temperament. Yeah, so I'm open for everything, bonds, IPOs, as long as it is in public market. I am also open for discussions around the private equity or venture investing, just that it's a different game. And you need to understand the difference, what's the pros and cons of it before you venture into that. So I don't do venture investing just yet, or PE. I do get a lot of proposals around PE, but I don't find anything which is more attractive from a risk return plus liquidity perspective, which today I can find on the public market. So I focus mostly on the public market for that reason. Okay. All right, session number 244. That means almost 4.5 years. Hope those who have joined for the first time, you will be able to get something out of value. And I will see you next week also. So the way I run this meetup is I do spend a few hours in putting together a content that we can discuss, but it's open if you have any other questions or a specific topic that you want to talk about, bring it up for discussion. Put it in the chat, and I'm open to have a discussion on those topics. There are some things that we are not able to cover today. I'll push it out for the next week. So I just want to make sure that generally it will be like 2.5 hours that you spend every day. Every Saturday is actually useful for you. Right? This is not for me. This meeting is for you. So make sure, you get the best out of it. Okay. All right. So let's dive into today's session. As always, anything that we discuss here is only for education and maybe a little bit of an entertainment if you can find any, but nothing is financial advice or tax or investment advice. So don't go and invest. Hey, I heard Vivek talking about it, so let me buy this XYZ stock and then I can safely retire. Right? That's not the way for investing. So do your own due diligence. We will talk a lot of stocks. We will talk about crypto. If there's a need, but you have to make your own decision based on what works best for you as an individual in your situation. All right. So let's start with something funny. I found this, this is a very, I guess, famous meme around waiting for it. And based on whatever we saw this week, if you're waiting for the bottom, I mean, you just keep waiting, right? The market just ripped higher. 2 weeks ago, almost, just not too far away, right? Just 2 weeks ago, on 5th, our meetup after 5th, right? The one that we had on 10th, right? The 5th of August, so-called Black Monday, where the markets went into tailspin because of the yen carry trade. And on 10th of August, when we met, and everyone like, what's going to happen in the market? Right. So super scared around the market. It's seen NASDAQ down 10% in 2 weeks, and everyone scared out of it. So those are the times when if you have a cash on the side, you can find some good bargains. Unfortunately, stock market is the only market where I see people don't like bargains. If the things are available at a discount, you don't want to buy it. I don't understand why. But that's a generally we'll see people running away from discounts. Anyway, so if you thought market's gonna crash, markets are up 10% from that dip, especially NASDAQ. I'll bring a chart for you, which shows this has been the fastest ever 10% rally on NASDAQ from the correction that they had, right? So this shows a number of trading days for NASDAQ to rally 10% from a correction low. So we had a correction low on 8th, and it took just 8 days before you even realize that, oh yeah, I'll invest it, but let me just wait for a day or two. And then you see market jumping over percent. Oh, come on. Let me make sure I have a funds. Market is ripped higher. It's up 10%. It's been the fastest ever in the history of NASDAQ, QQQ. So, sorry, and that is why timing the market doesn't work. I know there are many people who want to time the market. I'll buy at the top, I'll buy at the bottom, and I'll sell at the top. Doesn't work. Any great investors you hear, one common theme is timing the market doesn't work. Time in the market is the stuff that we should focus on, not timing the market. So only folks that I've seen for which timing the market works are either on YouTube or on X Spaces, right? They don't exist. I don't see anyone existing in real life, right? Who have been able to successfully time the market every time. You get lucky once in a while, that's fine. Everyone could get lucky. My neighbor's dog get lucky sometimes, but you can't do it every time. So forget about trying to wait for the bottom or trying to sell it out at the top. If you sell it, it goes further high, will happen. Buy it, there's 100% chance that it will go further down, right? So we can never time it. So if you were waiting for the bottom, I guess you'll have to wait more. Markets have ripped higher, and a lot of stuff has to do with what happened this week, right? So first of all, I just don't understand how come our government's data collection is so bad that the non-farm payroll growth was revised 800K down. And those people still retain their job. But don't you find it crazy? If you were working for a company and you do it, and this happens over and over, now I think as an investor, you kind of come to expect that the job growth numbers, the payroll growth numbers will be revised, right? And But the fact that there is a billions of dollars, if not trillions of dollars, that trade based on the numbers that come out, which will tell you the health of the labor market, it just boggles my mind that the trillions of dollars move on the numbers, and those numbers are way off from what the actual numbers are. So 818,000, the numbers were revised down by 818,000. If you go back and look at the history, those are generally always revised downwards, but this is the biggest magnitude, right? 800K. And we have so many companies, and here we're talking about making a decision based on a streaming data, right? Before the data even like the whole concept of IoT and all that. On one side, on the private industry, we're talking about making decision in real time by looking at the streaming data. That means the data is not even an hour old. The data is being analyzed the moment it is being generated and while it is being transferred to the storage database, right? On the other hand, these government numbers are so far off that I don't even know what to believe or not to, right? That is why investing based on macro just doesn't work. Investing based on timing doesn't work. Investing based on macro generally doesn't work. But good thing, at least this week, was because of this revision downwards, market knew that we're gonna get a license to party. And that's exactly what Jerome Powell did during his speech in Jackson Hole. So like last week, we talked about the fact that all the central bankers are having fun at Jackson Hole. They're meeting, they are talking, basically giving speech on what they are seeing in their respective economy, and which gives the hint of what the central bankers are going to do across the world, right? Are they going to tighten the monetary policy? They're going to loosen the monetary policy, etc., etc. So I think the three golden words that Jerome Powell uttered in his speech was, the time has come. 4 golden words, right? And that's it. Market ripped higher. The time has come for the Fed to now, basically cut rate. The Fed has to now step in because the labor market is now getting challenged. Inflation seems to be under control, as we have seen week over week. I mean, every monthly numbers we look at, even the recent numbers, when those inflation numbers they came out, it was better than what we were expecting. So Fed has got 2 mandates, as you guys know: price stability and maximum employment. So for the last 2.5 years, Fed has been focused on price stability to bring the inflation down. That's why they raised the interest rates to make it more expensive to basically buy the goods and services. That will reduce the demand, that will bring down the prices. Now we have seen over past many months that the inflation is now heading towards Fed's target. It's not at 2% yet. It's not at 2% yet. Don't get me wrong, that the battle has not been won, but the direction, the trajectory is pretty much where the Fed wants it to be. The recent numbers were 2.6%. Fed estimate was 2.8%. And I think if it continues in the same direction, we should reach Fed's target. So it's time to cut the rates. It's time to now loosen the tight monetary policy that Fed has held so far for almost 2.5 years. So market knows the rate cuts are coming. The question is, how many bips? Are we going to get 25 bips? Going to get 50 bips? And again, who am I to even talk about it? I don't know what's in Jerome Powell's mind, but maybe we're going to get 25 bips. If Powell cuts 50 bips in September, I don't know, that might send a little wrong signal saying, hey, there maybe the things are maybe worse than, maybe Fed is seeing something which is worse than what we are thinking. So, but I guess it's kind of a given that we will have a rate cut. Only question is, what's the magnitude of the rate cut that we're gonna get? So probably we're gonna have more than one rate cut. In different economists, talking heads have a different projections. I've heard numbers like 50, 2 rate cuts up to 50 bips this year to 100 bips by the end of a year. Who knows how much it will be, but one thing is for sure that we will have some rate cuts. So when you get a rate cut, what happens? All the companies, so-called zombie companies, or the companies that are dependent on cheap loans, it becomes a good situation for them. So not surprised that we saw IWM or Russell Index. I mean, that was doing party. Oh, come on, what happened to my thing cursor? Restart. Okay, hold on, I have to start my thing cursor. So that's what on Friday we saw. I think IWM was up 2% or something. And anyway, any of those long duration profit making companies, the companies that don't generate any profits now, but the profits gonna come in years down the line, they suddenly become more attractive because your base interest rate is going down. So ARKK funds, Cathy Wood companies will do good, and that showed up on Friday. So generally, rate cuts are good for the stock market because it increases the attractiveness of investing in the market. And now the question is, how much of that is already priced in? We don't know. We will never know it. But so far, so good. Let's see what the Fed watch tool tells us in terms of how much of a rate cuts is being priced in, or what the market is expecting, how many rate cuts we're going to get this week. So, oh, come on, where's my probabilities? There we go. So current one is, I think, 525 to 550 bips. And we're gonna, our 76% for sure, we're gonna get 25 bips cut. Almost more than 50%, 75% we're gonna get one. Then looks like by the end of December, yeah, we can have half. We could get almost more than 100 bips, or 100 bips or 75 bips by the end of the year. That's what the market is currently pricing in. We'll see what Mr. Powell does, but 50 bips, I think would be okay. I'm not sure if you're gonna get 100 bips, but looks like 50 bips probably we will. Anyway, I have no idea what Jerome Powell is gonna do, but that's what makes investing so much fun, right? I see a couple comments. Sachin says they have to cut at least 2 months of election to show results and bring a feel-good factor to government. Yeah, you're venturing into an area which is a little slippery. I know Fed is supposed to be politically neutral. They should just look at the data and not worry about who's going to be in the power, who's going to be in White House. But we know how these things work anyway. Sam's talking about book value of PDD, Baidu, and Alibaba. There's some message around that. Okay, I know these Chinese stocks are, I'm not sure about PDD. I've never looked at PDD. Baidu also I have not looked at deeply. I do own Baidu, but not a big position. But Alibaba, I've talked so many times about Alibaba. It is one of the cheapest stocks that I hold in my portfolio from a normal valuation perspective, but there's a different risk on Alibaba.
The reason I brought it up was because Pinduoduo has the market value about the same as Alibaba, so I just thought of.
Yeah, I thought probably earlier it was even higher than Alibaba, so it had surpassed higher than Alibaba, but I think because of the recent jump in Alibaba shares, now probably it has become bigger than Pinduoduo. So this is one. Tim, I'll get back to you. This is one thing which is like perception is more real than reality. As an investor, especially US investors, we always think Alibaba is the biggest one. But you know, JD.com did more revenue than Alibaba. Forget market cap. JD.com did more in revenue than Alibaba in this quarter. And when it comes to the overall market cap, like we talked about, Pinduoduo had a bigger market cap than Alibaba. Okay. So, yeah, but we'll talk about Alibaba. I have something to share about Alibaba.
Can I talk about JD? The thing is, they have rules now.
So hold on,
before-
Sam. I'll have to get to T. He's raised his hand, so let me just go through T first.
Sorry about
Yeah.
Hey, just one quick thing. I just want to throw it in there. Well, actually, two quick things. Number one, since we're on Alibaba, do you trade stock options against Alibaba and Vivid?
Yeah.
Okay, cool.
I have a stock
looking
as
for
well as
cheap-
options.
I look for cheap stocks like Ford that you know is going to be around. You just don't want a company that's going to, pump and dump, that you don't know anything really about. I look for cheap stock options companies to have in my portfolio to trade options against. Number two is I'm curious about something. Do you, if I were to send you a link, could you analyze some stocks for me? You don't have to do it on this call. I'll just send it to you in the chat and you can just look at it when you want to. Because I'm looking for high dividend yielding stocks that's quality. And I just wanted to send it to you. You don't have to do it on this call if you don't want to. But I'm going to just send it to you in the chat. And I just wanted to let you know.
Yeah, you give me the ticker, but I do accept stock review requests, but I have a requirement. You give me the stock ticker, you give me who's the CEO and what's the market cap of that company.
Okay,
So,
gotcha. I'll send it in the chat. Thanks a lot, Vivid. Go ahead, whoever that was speaking. I think
sure.
Albert.
Yeah, Sam.
the thing is, in China, they have rules. Before, when I was in China, they had no rules for the delivery, the moped people, and now they have rules. And that's going to be cost a lot for JD and Alibaba.
Yeah, I mean, it's not now, right? It's been like
labor.
It's almost 2 years since Chinese government had started, tightening the rules and the anti-competitive behavior that these companies, the big companies, have been, doing in China. And that's the reason why we saw all the sell-off in China. And of course, over the last 1 year, the Chinese economy is in doldrums in terms of all the defaults that we have seen on the property side. That is also to contribute. The consumer is stressed out, but when it still, I think from the valuation perspective, the stocks are given up for dead, right? And for the reason that it's a Chinese economy, we don't know when the government could step in and nationalize these companies. So this is a different kind of a risk that is involved, and you have to be comfortable with that risk, or a position size. You have to size your position accordingly. I'm so tempted to add more to my Alibaba position, but I can't, because that's going to violate my position size rule, which I don't want to. One lesson that I've learned in years of investing in: you can go wrong on everything. You can pick the worst stock. You can pick at the worst timing. You can pay the highest price. But if you keep your position size okay, you will live, you will fight, you will survive to fight another day. But if you pick everything right, you've gone too big on your position size, you're going to blow up your account like many hedge funds have done, right? So that's the reason. Otherwise, I would have made Alibaba my biggest position, but I don't want to violate my position size rule. Okay. So since we talked about Alibaba, let me jump on to a content that I had for Alibaba. So there is something called, so on 28th, Alibaba shareholders approved Alibaba shares to be listed as to make Hong Kong as a primary exchange. What that enables, and this is like, very particular quirk between how the Hong Kong and China stock exchanges interconnect with each other, even though now Hong Kong is a kind of part of China. But you still, if you are and Sam, you probably can tell more about it, but if you are a mainland Chinese China resident, you cannot invest in, let's say today, the Chinese investors cannot invest in Alibaba. Even though we say, hey, Alibaba is a Chinese company, the investors from mainland China, they cannot invest in Alibaba. So Alibaba has been working it for almost I think it was like 2 years ago that they decided to have their listing, to make Hong Kong as their primary listing, which enables them to join a program which connect the Shanghai and the Shenzhen stock exchange together, right? So I think it's called a Star Connect or something. So when you become a part of that connection, now the investors from mainland China can actually buy Alibaba stocks that are on Hong Kong exchange. So sorry.
I thought they did that 4 years ago.
No,
5 years ago. They tied Shanghai to Hong Kong, or Shenzhen to Hong Kong,
No,
or Beijing to Hong Kong.
so you're right. The connection was done, but now not all the stocks are available, right? So your shareholders need to approve that, yes, you will make your Hong Kong as a primary listing. Then you become eligible to be trading through that channel, right? So for example, Tencent has been approved. And so if you look at some of the other Chinese companies like Tencent, their performance has been much better than the Alibaba stock performance, right? So Alibaba shareholders approved it on 22nd, and on 28th, Alibaba will be eligible, basically become a primary listing on Hong Kong, which will enable them to become one of additional ticker that will trade through that connection, which Sam is right, that connection was established almost 4 years ago, but not all, the stocks have to go through the process before they can start trading through that connection. So if the mainland Chinese investors can invest in this stock, in Alibaba stock, so-called Southbound Connect program, which means basically the money coming from mainland China to Hong Kong in south direction. Firms' estimates are that maybe around 12 to $20 billion in first 6 months of a capital will flow into Alibaba stock. That is the reason why we saw, Alibaba stock did better, this week. Come on, Baba. Yeah. So that's one of the reasons why the stock did better this week, is because there may be more capital infusion. Now, whether it's gonna be, now the bigger question is, in the long term, how will this perform? So long term, the performance is mixed. I mean, there was another article on Bloomberg that I'd gone through it. I think I responded to someone on X. It's been a mixed reaction in long term. Some of the stocks that went through this Connect program were up after a year. They were up 30%, 40%. Some of the stocks were down. I think like stocks like XPeng is down 30%. So long term, the story is mixed. But I guess for a short term, this is kind of a tailwind of additional capital flow into the stock that should generate more interest. Essentially, the idea is now the Alibaba stock will be available to a set of investors that so far did not have access to invest in Alibaba. So essentially, that's a new update on Alibaba. Anyway. So we were talking about rate cuts, right? So before we go and start celebrating, pop open the champagne. This is looking at a different rate cuts. Stock market performance in 3 months following the first rate cut, right? So now 1984, nothing much happened. 1987 was great. 1989, yeah, stock market was up 10%. So you can look at it. I think it was up more times than it was down after the first 3 months. 3 months after the first initial rate cut. We'll see what happens during this rate cut. So we got what rate cut coming in September. Maybe, I don't know when the Fed meeting is in September. Is it in the mid, or let's assume it's in the mid of September. So that means, yeah, mid of Jan, after 3 months, we should see where the market is. But given that it's an election year, I don't think we can attribute every change in the market to the rate cut. But generally, rate cuts are good for the market. Long term, it's anyone's game, right? Now, 1 year and 2 years later, majority of the time it was good. Right? In 1984 rate cut, 1 year it was up 8.6%, 2 years later it was up 40%. Right? I think there were 2 years, 2001 and 2007, and we all know what happened there. The rate cuts were done because the economy was like, the markets are almost, those were frozen. The credit markets were frozen, so Fed had to step in, and the returns were horrible. But other than that, on all other cases, the 1 year return as well as 2 year returns have been pretty decent. Again, don't time the market. It could go down or it could go up. This is just the history, right? History may not repeat, it may rhyme though. So I'm still staying invested in the market, right? And reduce the cost basis, just manage the risk. That's my mantra. I see one comment. Rules. Okay, so my biggest regret was selling Microsoft to diversify my stock holdings. Yeah, hindsight is always 2020. Good that you held Microsoft and you were not holding, let's say, GE, or pick any other stocks that don't exist anymore. But here's my counterpoint to that. And I know, I mean, this is what I personally have been doing, right? When I'm new to investing, I will diversify. As I become more and more mature in investing, I understand the companies more. So that's why now you see last 2 years, I spent time, almost 3 years, I've been spending time to concentrate my portfolio, right? From 110 tickers, I'm down to now 60, which I still feel is high. I have ETFs as well, but majority, like top 10, 20 is more than 80% of my portfolio, right? So because now I can spend time on understanding my company. I understand their, the financials, I understand what the CEO is doing. That's the time when you start to concentrate. I am a firm believer of the saying, to build insane amount of a wealth, concentrate your portfolio. To blow it all, concentrate your portfolio. So it's a double-edged sword. So depending on how confident you are, you gotta take a call.
The issue, Vivek, is I knew Microsoft and I changed, and I did. Well, who would have known HP was so bad? But anyways, the thing is, remember in the past, I brought it up to you that I was listening to all these other professional investors, traders, but I didn't really know what I was doing. Just kind of like Apple. Should have bought Apple, and these are stocks that you stay out for the rest of your life.
Yep. Anyway, okay, T, go ahead. T, you had a question?
Yes, I'm curious about something. Would you invest in Clip? Because Clip is a Chinese internet company, and I thought the internet in China, would never go down. It has a high dividend yield. Knowing your stance on that, would you invest more in Clip for a high dividend yield as a diversified portfolio? There's other ones out there, but I'm just curious since you brought up China.
No, saga. So I've not looked at that company, so I can't comment. But I just don't invest based on the dividend yield. You also need to know what the payout ratio is, right? That will tell you if the company is sustainable dividend or not. The company may be paying dividend because it's at the, it's already mature and it's now kind of in a decline phase of its life. Company goes through a life cycle just like humans do. And once the company matures and don't see any more growth in their business, they'll start to return more capital to their shareholders, start to increase the dividend, and so depend on what kind of investor you are. I'm not a dividend investor, but I'm not averse to investing in dividend companies, especially, I mean, the Chinese company that you mentioned, I have no idea about it. I just won't invest it just because it pays dividend. I at least want to make sure that the business is solid, the dividend is sustainable, the payout ratio is small, which they can just, maintain for future. That's my take. I don't know which company is that, though.
Okay, cool. I just wanted you to elaborate on that. Thank you very much, Vivek. Go ahead.
All right. Does anyone know of a way to watch multiple charts at the same time on the same screen? I don't know. Is you talking about Think or Swim, or is it a different one?
No, I was just curious, is there a way to watch charts at the same time? Some guy told me some strategy. He said that if you use an ETF that monitors tech stocks, and you monitor one of the tech stocks, once the ETF starts moving up, the tech stock should follow it. And he had it both on the same screen, but I wasn't able to pinpoint how he was able to look on one screen and have multiple stocks, going at the same time, graph wise. So I was just curious if anybody knew one.
I mean, on Think or Swim, I know you can create whichever, how many number, whatever, how many these are, like 32 or something. You can create how many ever screens you want to, but again, I am not a day trader. I never had a need to have more than one screen, but I know of many people who have like 6 or 8 monitors on their trading setup, looking at various stocks. I'm not one of them.
Yeah, I didn't want to do that.
Okay. All right. So what happened in crypto? Now everything is rallying because we're gonna get a money printer is coming, will be loose. We're gonna get some liquidity in the market that pushes up every so-called asset. So I won't be surprised if I see now jump on the real estate side. I think a lot of real estate or housing stock already went up after the labor report came out, after the market started to assume that we're going to get a rate cut. I'm sure mortgage servicing companies probably will go up as well, because now once the rate cut starts to materialize, you should see more refinancing. The business that had been almost dead for 2.5 years, right? I think previously I talked about numbers. The mortgage refinancing was down 85%, right? So now those businesses should start to pick up. So mortgage servicing companies, home builders companies, those stocks probably already went up. I know home builders went up. Mortgage servicing, I don't know. I hold only one, which is Rocket Mortgage. Let me see. Did that make a move? Not. Well, it had up like 52-week high. So, yeah. But it's because the interest rate is going to come down, right? And the crypto, and this is the only thing that I'm going to talk about crypto today, is crypto is still considered as a risk asset, though those who are in crypto would say, oh, that it is low risk asset. Majority, the norm is for them, crypto is still a risk asset. So when all the risk assets are going up, when the cost of capital is about to get low, the risk assets become, they move up. So we saw suddenly Bitcoin is up like 9%. This is my screenshot as of yesterday evening. This space moves pretty fast and it moves 24/7. So I don't know where we are now. Not bad, 64,000 still. And Ethereum almost 2,700. Yeah. So crypto is also up. It's like everything up really right now. Okay, I see a question. Any option experts? In general, is it safe to assume if call volume in open interest is significantly higher than the put volume, it's a bullish signal? So this is something called, this is what called a put call ratio, right? There's a one way to look at if the put call ratio, if the call volume is higher, then markets is taking a bet on the higher side, right? Doesn't really mean that the stock is gonna be bullish. So, and I'll give you an example, right? Say I hold 1,000 shares of Nvidia. Nvidia is reporting earnings next week on 28th, right? It's a big part of my portfolio. So what could I do? I could sell my shares today and I just buy calls as a smart insurance. What do you think? Am I bullish on Nvidia or was I bearish on Nvidia? So me personally, and I know a lot of folks do want to take some signal out of a put call ratio, even when we look at a fear and greed index, which I'll look at in a moment. They also consider put call ratio to figure out if there's a bearish sentiment or a bullish sentiment. Right? But I don't follow it blindly. The fact that anyone buying a call is bullish or anyone buying a put is bearish. Why? Because I don't know what the rest that they hold in their portfolio. An example I gave you, I sold my Nvidia shares, long shares I sold, and I bought a call. I could still be neutral. I could be bearish. I might have reduced my overall delta, Nvidia delta, right? So there is no way for us to figure out unless we know what else that person has done. And that's why I don't take that as a signal to manage, my portfolio. I don't know what else you might hold in your portfolio. You might have just done a stock substitution trade. That
What
means
kind of car did you get? Was it a Camaro?
sorry. Was that a question? Or
Yeah.
probably this is
Yeah, was that what kind of car did you get? Was it a Camaro
which
or
car?
a Challenger or Mustang? I thought you said you sold your options and got a car. Never mind that. I thought you
No,
said you got a car.
No. Sorry.
Oh, okay. No, sorry.
So you never know, that what else that trader has in their portfolio. That is why I don't treat them personally as a signal to manage my portfolio.
Vivek.
Yeah.
So, but a lot of people are watching the option flow these days, right? They look at the option flow. I mean, I'm just talking about in general. I mean, individual, yes. I mean, it could be a person just sell the cover call, retailer just pick up those calls. Then, you can't say it's a bullish per se, but at least not the bearish, right? If like a lot of retailer pick up the cover calls.
So so cover call means you're actually selling a call. You're buying a stock and you're selling a call. So
Right, but at least if I'm a person, I'm selling the cover call, I'm expecting the stock price will stay below a certain price, but that at least didn't. I'm not expecting to go down significant, right? Or if I sell a huge cover call and there's a lot of retailer pick up those calls, then those retailer, they are relatively confident, even though they are like small contracts each. But they are, I mean, together, at least give us some signal. At least retailers are confident or bullish. Or, I mean, other scenario, like if a big individual buy a big volume of contract at the ask, then that's definitely the bullish signal, right? I'm just talking in general. Like if I see for a stock, for a particular expiration day, strike price, the call volume is significantly higher than put volume. I mean, let's give us some level of the confidence of the
and I'm telling you,
signal, bullish, right?
Yeah, so the call volume significantly higher than the put volume means market participants are expecting that the stock is gonna go higher. Whether the stock will go higher or not, nobody knows. Right? So you're betting that the stock will go higher, so hence you are willing to buy a calls at buy more calls than buying more put, which is for protection. The market participants are thinking. Let me put it that way.
Yeah, market participants are thinking, but the price itself is decided by the market participant, right? It's just that it's decided by big whales or just small individual retailer investors.
So and I don't trade based on price. In anyway, so may not be the right person to ask this question, but I have seen time and time again, so now it's happening with Nvidia, right? Any of those meme stocks that happens, now it's happening with Nvidia is, hey, I'll just buy a call because if Nvidia goes up 20%, I'm gonna make like 10x, 20x, right? So, but we have also seen where the stocks have gone down 20% and all those calls could expire just worthless. So I don't derive too much signal out of it, just not my trading style. All right, year to date, there is a book on option flow. I've not read it, and I completely agree with you. There's a whole study around, you can subscribe to ORATs. They do a good job of reviewing the option flow. I just don't have a time to, me personally, I don't put a lot of faith in that. I want to be other kind of investor, so it doesn't gel with my personality. And hence I'm not in it. I don't pay attention to option flow. I'm not saying that you cannot derive some intelligence out of it. All right, year-to-date performance, pretty good, man. 17% high.
Vivek, you said subscribe to what?
There's called ORATs, option research. So this is being run by, let me just see if I can put it. Again, I have not subscribed to this. Option Research and Technology Services. So they do good analysis around earnings movement and, post earnings movement, what happened, option flow and all that. You could, look at it. I've not looked at it. I know the name because I listen to a podcast and they are generally a sponsor over there. Sometimes the folks from ORAX will come and talk about it.
Thanks.
Cool. All right, so S&P 500 is up almost 17%. And if you're in information tech or communication, 26%. What still keeps me, surprised me, utilities. It's like utilities generally considered as, grandfather or grandmother stock. Doesn't move much, will pay you dividend. That thing is up 18.2% this year. This has been, unlike any years that I've seen in my investing, is when utilities is actually doing better than S&P 500. I don't know when that would have happened last. Maybe when like 60, 70 years ago, when utilities were the new, like the internet companies of that era. Utilities are up 18.2%. Again, a lot of driven by the demand from AI. The electricity demand from AI, that is pushing up the stocks of a lot of these utility companies. So you could have been in any sector and still would have made more than what your bank is giving you. Even the worst one, consumer discretionary, is up 4.26%. As a retail investor, you could just buy index and sit tight. Would have still made 17% year to date. Looking at fear and greed index, we are now in neutral, not yet gone to the greed yet, but remember last week we were in fear. So just 1 week can make a huge difference. And that's the difference that this week has made. Again, all because, hey, now the job market is kind of a cooling off. And the Fed has to step in to make sure that we don't get into recession. We don't have a widespread unemployment. And that means we're going to have a money printer working overtime. and that pushed up all the stock prices. All right, so these are the 3 stock, and for next week, I'm gonna take 2 stock requests. So again, all I need is CEO of the company, the stock ticker, who is the CEO, was the market cap. Okay. So last week, do we have Cyrus? Cyrus had requested for Chegg. He's not.
How does that make a difference? Who's the CEO of a company?
How does it make a difference? So here's my idea. So the idea for me is to make sure that if you are looking for a company, you at least Google to get the name of the CEO and for the market cap. When you Google for that company, you might come across some news, my idea is to push you guys towards becoming a better investor. Means when you Google for it, you might come across some news that might be interesting to you. That might put you in, hey, I want to know a little more about what's happening with this my company. That's the reason, right? That's the reason I want you to give me at least 2 things. And if you own your company, make sure you know the name of the CEO. The idea is not to know the name of the CEO. The idea is that you want to be knowing more about your company. And at least if you're doing this, you're Googling for the CEO name, you're seeing something, hey, these are the news about your other company. That's the reason why I'm pushing for it. Okay. So Cyrus is not here, so I'll skip. Toast, Niyanka, I saw her name. Niyanka is there.
Yeah, I'm here.
So let's talk about Toast. Again, this is not a deep dive. Today, I'm going to do a deep dive, I think halfway on Arista Networks, because that's a stock I talked about a few weeks ago. And I said, hey, I'm opening a very starter radar position on it while I'll continue my study on it. So I'm like halfway done on my study. I want to share. But this one is like, you guys know, this is like a quick overview on the financials. I'm not going to talk about the story behind this company because I've not looked at what Toast details are. That Niyanka, you need to tell what your story is on this company. Okay, so I'm going to bring up the financial side, do a quick bird eye overview on how it looks like across various metrics that I want to track. So I don't know about this company. Let's see what we discovered. Toast. Look at their YTD numbers. PE ratio, nothing, means probably doesn't make any profits. Forward P 38, pretty expensive, but that's okay. As long as it can show me the growth part of increasing the earnings should be okay. Revenue, 4.3 billion. Yeah, no income. Debt to equity, very low, so not levered, which is fine. Cash, they got a market cap of 13.3 billion, enterprise value 12.1 billion. So yeah, more cash than debt. Almost no free cash flow. I think it's a company has been around only we have only 5 years worth of financial data. So it's a new company. So this is company which is, I guess, beyond its startup stage. But it's still kind of a teenager. I would say like less than 15 years old kid, right? Not yet mature. So that's what the company is, and it will behave differently than the companies that are now adults or mature, right? So I can't put the same, and I cannot review it and measure it with the same benchmark like I would do it for a mature company. So let's look at from a business perspective, right? Does it have a moat? If it has really have a good moat, it should show up in a good gross margins. Doesn't show yet. Last 1 year of data. Good insider ownership though, 21% owned by insiders. So our interests are aligned. Of course, no dividend. They've been diluting shareholders. So because probably they don't make much money from their operations, and they need to know, they need cash. So either 2 ways you can do cash, you can raise debt, which they don't have much debt, or you can sell more equity, which is, guess what they've been doing in? Either they're diluting it because they're raising it to public market, or they're conserving the cash and paying employees through their stock-based compensation. In any case, it's still a dilution. Don't like that. Negative operating margin, no profit margin. So this is a growth story. They've been growing revenue, even though the growth is coming at a cost that they will continuously have to depend on the largesse of outsiders, which means either from a debt capital or from an equity capital. Right? But they're growing. Let's look at maybe last 3 years. Same story, right? So it's a growth story. Let me put it that way. It's a growth story. So looking at a valuation doesn't make sense right now because they don't make any money anyway. So now the question is, it is just a growth story, and what are you willing to pay for that growth? Do you buy into that growth story? I don't know the story of the company. I know that the Toast is basically now any investment thesis, like I've talked about multiple times, has got two parts. One is the numbers part, one is the story part. Right? We don't want to ignore either of these. Toast, looking at the numbers doesn't make much sense because the company is not even working for these numbers, right? Company is not managing its business to generate cash flow. So that what's the point for me trying to do a discounted cash flow valuation or reverse DCF? Company is not even at that stage. Company is not even at a stage where they're worried about generating net profit. So talking about PEs doesn't make sense. So numbers, not much. Now let's talk about the story. Toast is a company. Let's see, we should have something which says what the Toast is about. Right. So Toast, come on. It offers cloud-based end-to-end tech digital platform for restaurant community. So basically, if you go to a restaurant, you are, paying for a restaurant, the payment terminal, or maybe how they manage their restaurant as a business. Toast provides that. I've seen a lot of others like Clover, at least on the Bay Area. I see more Clovers than no, I think I've seen Toast at multiple places. Yeah. So I see Toast at multiple restaurants, as a payment terminal. So basically they provide this whole terminals and SaaS software for restaurants to manage their business. That means included restaurant operation or point of sale, which is where you and I as a consumer attract, is the point of sale, digital ordering and delivery, marketing, loyalty, team management, supply chain, accounting, everything. Right? Now you have to think about is this a business wherein they have any differentiation? Now it's all the story stuff. Have you heard about what the CEO or has been talking about? Its story. Right? What's the story that they have? How fast can they grow? How quickly can they capture the market? Does this business have a moat? Like I said, I see Clover. I know Square is into the similar space. Square is actually focusing on a vertical for restaurants. So I don't see much moat on this one. So I don't know. I'm not too interested in it unless it proves me otherwise by showing up the moat and that the business is actually profitable to show up in the numbers. Today, sitting now, I don't see anything which is any other company can't do. It's a $4 billion market cap. Are you saying me that, hey, if we offer $4 billion to another company, they can't create a restaurant management software? I guess they could. Maybe, I don't know how many customers Toast has. So that maybe, they have a head start, but then there are other companies in the same space. Right? So, and if my story is wrong, then invest in it. Today, I can't say anything based on the numbers. The company is at a life cycle. The company is at the stage of its life cycle where the talking about numbers doesn't make any sense. Right. So now shares is trading at $23, right? Just for the heck of it, right? Let me run a reverse DCF to see what's being priced into the shares. Right? So you're looking at almost 27% free cash flow growth for next 10 years. Just if you're looking from a basic valuation perspective, right? I've not seen many companies do it. I don't think Toast has a big moat around it yet. When I'm talking about moat, we can have a moat from a switching cost, right? Yeah, there is some moat on the switching cost because once you deploy one software, it may be difficult to switch, but I don't think it gets so integrated that it is impossible to switch or that it is too difficult. That's my reading. If you have a different story, then you may have a different outcome from an investing perspective. I'm not interested in it yet. I want to wait for it to prove me that it is worth my money. So that was Toast. Good 5 minutes overview. Let's talk about the next one is Mercado Libre. Aditya had asked for it. I mean, I own Mercado. I don't own Toast. I own Mercado Libre. This is my biggest individual stock position. So let's bring up Mercado Libre. This company, I know it. I know it very well. Toast, I didn't know it. I know the story. I know the financials of Mercado Libre. So anyway, so I just reviewed it during earnings as well. So Mercado Libre is basically so-called Amazon plus PayPal plus eBay of Latin America company, growing pretty fast. It's been around for almost 15 plus almost 20 years. CEO is ex-Stanford guy, went back to Argentina and wanted to create a new Amazon. They did a much better job than what Amazon had done. Even Amazon is their competitor, but no longer, doesn't stand anywhere near Mercado Libre. And then they expanded their operations into the whole of Latin America, blah, blah, blah. I've talked a lot about it during the earnings review. But let's look from a numbers perspective, right? PE is high because, again, it's a growing company. So I don't want to focus on the PE because it is still not focused on net income. It is still focused on investing every penny into expanding the networks, right? Recently, they added more warehouses into Brazil and Mexico. So look at their revenue, $17 billion revenue, $1.4 billion net income, which is a little surprising that they're still generating net income. Remember, right? Amazon, e-commerce is a difficult business. It's a huge capital intensive business, right? You need to build the network, but they're able to generate some nice net income. So credit to them. Have a little bit of a debt. Total debt is $5 billion, but enterprise value is lower than market cap. It means they have more cash than debt. And again, this debt is more from a capital structure perspective. If they want to pay off the debt, they can. They have a more cash on hand than the amount of a debt. So it doesn't bother me that they have a debt. They've been able to generate some free cash flow. I don't know why they're focusing on free cash flow at this point of time. They should be reinvesting every money back into the business. 50 million shares, 49% gross margin. I'm happy with it because if it was a software company, I would not have been happy with it. But it's a e-commerce company. Almost 50% gross margin in e-commerce is a decent enough. I guess once the mix will start to change from first party to third party, which is what they're focused on. We should see this gross margin coming down, but the volume will increase. So that should be fine. Dividend, buyback. So they bought back some shares. That is a good news. Revenue growth, 37% growth in revenue, wherein you are actually doing a $17 billion of a revenue per year is impressive, right? EPS has been growing, CapEx not too much. I expect them to even have a higher CapEx, but at the last 1 year doesn't show much. Let me go back and look at last 5 years, right? So they did issue some stocks earlier. or did a more SBC, but it looks like over the last between 5 years and now, they've got a little more control on the stock dilution. Yeah, I think, yeah, looking at 5 years on, except the valuation, right? Nothing. The business side is still good. You can't get it cheaper. So if you're going for a traditional PE valuation, etc., you'll never touch this stock. But the company is currently not optimizing for earnings. They are optimizing themselves for growth, but responsible growth, right? Which is what I'm seeing in this. So over past 5 years, the revenue has grown on a CAGR of 60%, and the market cap has grown on a CAGR of 43%. Of course, you can tell me, hey, you should look at a earnings growth, but right now it's not even optimized for earnings, so I can't talk about it. But it's been growing revenue at a nice plug, and the market has also rewarded it. So this is and again, I have you can say I have a cognitive dissonance because I own this company, and that's the reason why I own this company, is that the numbers show up nice. Right?
Thank you, Vivek. Do you think they have a moat?
They do have a moat that's why they're building the moat, right? That's why they're building the warehouses and be able to ship goods at a faster than any of their competitors. So it's not that they don't have competition. Amazon is there.
Yeah.
Now you're a C
Yeah.
Limited has now doing business in Latin America. So they are seeing a competition, but despite that competition, they're still able to grow their revenue. They're still able to maintain their nice decent margins. So they have built a moat, just like Amazon has built a moat of their network, right? Their fulfillment network, and that's what Mercado Libre has done. On top of it, the one thing which Amazon doesn't have, which Mercado Libre has, is Mercado Pago, which is their payments platform, which is used not only on Mercado's website, but it's like you go to Safeway or whatever the grocery chain, Albertsons, and you're paying there, you're actually paying equivalent of as if you are using Amazon Pay to pay in Albertsons or in Safeway. Mercado Pago is being used as a payment channel even in offline stores, which is a huge. I expect that business to grow at much faster pace. So that I don't think any US e-commerce companies have been able to achieve what Melli has done. So I think they have built a moat. They're into other businesses also, like capital loans. And if you look, when we talked about the recent quarterly earnings, they've increased their loans, but responsibly, so they don't have a non-performing loans increasing, right? So at least I like the management and what the company has done over like past 10, 15 years. That's why, I'm comfortable holding it, even though from a valuation perspective, it is not cheap. That's the problem, right? Amazon would have never been available at a cheap valuation. So let's see what's being currently priced in already, right? So past 5 years, they have grown their free cash flow at 86%. Let me go back and look, which I believe is crazy. Analysts are expecting them to grow on an average next 5 years, revenue growing at 23%, EPS growing at 37%. If I assume, that somewhere in middle, they'll be able to grow their cash flow, or at least they have an ability to grow cash flow, whether they do it or not. I would rather have them invest every penny back in the business and not grow the free cash flow. Well, let's say if they have to, let me take it 25%. That's going to be a crazy number. So what is market currently pricing in? 10% free cash flow growth, which could be fine because, hey, if they have to continuously, maintain their moat, they should be reinvesting everything back in it. So Just from a free cash flow perspective, market is pricing in 10% growth in free cash flow for next 10 years. Over the past 5 years, they've grown their free cash flow at 86%. And let's say if I want to look at what have they done from a stock-based compensation, etc. Look at this chart. So looks like they did some secondary offering. I mean, what's not to like? So anyway, we're not gonna get into the details, but yeah, I'm cool with Mercado Libre. I think I'm still be open to invest more on this one. So this is my
thank you.
biggest position
And
in portfolio.
So just placing them in terms of the business. So it sounds like the guys play really well in the local markets. So intellectually, I'm almost tempted to consider them at like similar or better than someone like Flipkart in India. Maybe would you say that as an accurate statement apart from the Pago business?
So I know Flipkart runs and operate e-commerce business. I don't know about their payment side of house. Do they have their own payment solution, or they basically you pay via Paytm or one of the other payment providers? I've not used Flipkart.
Sure. I know they were doing cash on delivery model, which is very suited to the local markets. Again, being based outside, I personally haven't used them.
Yeah. So but the problem so both like India market or some of the other, let's say, African countries, etc., they still are not that mature from an e-commerce perspective. But is it equivalent to Flipkart? Again, I've not looked at because Flipkart is not publicly traded individual company. I mean, it's a part of Walmart. Walmart bought Flipkart years ago. So we don't have its individual financials. So I really don't know how Flipkart is doing from a business perspective. But does it operate only e-commerce website, or does it have other avenues of business, right? Other business units like Mercado Libre has, which means Mercado, they have a credit management business. They have an investment, which is very small, loan, Mercado payments that we talked about. And now they still haven't breaking it down, which is advertising. I think once advertising become big, they'll start to break down that as a separate revenue stream. You have to dig through the reports to figure out what they're doing in advertising. And I don't know how much Flipkart has, so I can't give you any comparison. All right, so that was Mercado Libre. So shall we look at earnings? Or we can maybe come back to earnings if you. All right, maybe let's talk about what are the earnings next week. And if there is more interest to talk about the earnings past week, Snowflake. And again, I don't have the details. I don't own Snowflake or Zoom, but I can quickly pull up in terms of quick financial overview of their earnings. Next week is the week of Godfather Jensen Huang, right? Forget about everything else. Forget about any other company. Next week belongs to Nvidia. The market belongs to Nvidia. Nvidia may be able to move the market more than Jerome Powell had moved the market. Imagine the power that Jensen Huang holds. So Nvidia is reporting on 28th, Wednesday, after close. So get your popcorn ready. Get ready for some fireworks. Depending on what Nvidia comes out with, you might see its impact on the rest of the stock market as well, right? So Nvidia has already been up like zillion% in over the last 2 years. We'll see if it can still prove that it's worthy of that high valuation or not. So what else is coming up? PDD I don't own. So Monday gonna be cool. I can spend a lot more time in reading some of the shareholders letters that are pending, because this whole earnings season has kept me so busy that I'm falling behind on the stuff that I have to read upon, right? A lot of Barron's and Bloomberg's and shareholder letters are piling up. I need to catch up through that, which I will now be able to do it. Nothing on Tuesday. Sentinel-1. I don't own anything for Tuesdays, big ones. Li Auto. I own a bit of Li Auto in my portfolio, so we'll see what they report. Nvidia, CrowdStrike, Salesforce. I don't own
Do you do
Salesforce.
any
I own
investing of
CrowdStrike.
dividends at all?
Sorry?
Do you do any investing of dividends at all, or do you do absolutely no dividend investing whatsoever?
I use
None.
SCHD. You'll see at the end of every month, I'll share my portfolio. Top 10 holding is SCHD, which is a high yield dividend ETF.
Okay.
What else? Best Buy, Dollar General, Dell, Lululemon, Ulta Beauty, Marvel. So sometimes I feel maybe I'm thinking maybe it'll be next week or week after that. I want to do one session around fallen angels. So today, sometimes you get these thoughts when you're in shower. Just before the session I was taking shower, I was thinking, earnings is over. We are doing stock review. Then I realized maybe I should do something called fallen angels. To talk about the stocks that were darlings or revered stocks have now fallen on the wayside just from a stock price perspective. So I want to go back and look at, is the business, so is it the stock that has gone bad or is the business that has gone bad? So a few things that came to my mind was Lululemon, then Nike, Starbucks, I don't know, Ulta, because now I see Ulta, I'm like, maybe I should add Ulta. So if you have some fallen angels, give me some idea. I'll think about, basically get these financials, similarly, see what they have done in the past and see what the little bit story around it. We'll do one session on fallen angels. Okay. Anyway, so we got a Dell, Lululemon, Ulta, Marvel. I guess Dell may move a little bit, will give us some idea around what the AI hyperscalers may be thinking of. Other than that, nothing which is a market moving stock. I guess Nvidia is the one. CrowdStrike will be on the cybersecurity front, and Dell might give us idea about AI. I guess Lululemon is similar to Starbucks, little luxury brand, but being challenged. All right, so it'll be fun to watch Nvidia. So yesterday, it was yesterday, I looked at Nvidia again and went back, and so our narrative in the market is Nvidia is all about AI. So I went back and looked at 1 year, 5 year, 10 year, 15-year data on Nvidia to see how the numbers show up on high quality metrics that I track, right? So here's what I tweeted about it. Man, it's a damn good business. There was no AI 10 years ago. I mean, AI, the way it exists in today's form. I mean, the machine learning has been around for 5-10 years. Or the deep learning have been around for remember, IBM Deep Blue, right? And so AI has been around for some time, but the hype, the AI in the current form hasn't been around. He's only came into picture since ChatGPT came out in November 2022. Look at the 1 year number, 5 year number, 10 year number, and 15-year number. It's a freakishly cash flow generating machine. Like 15-year average cash flow means $3 billion. If you sum up total, it's like $45 billion free cash flow that they have generated over 15 years. $35 billion, for 5 years. So, of course, AI is helping it. But even in the times when there was no AI, Nvidia was still able to find a way to deliver a good business. So I'm not going to bet against Nvidia. Now, the question is this, it's a great business. The question that I struggle as an investor is, could it be a great investment? A good business, a great business could be a bad investment if you pay up too much for it. Now that is something which is a little hazy. You never know what's priced in. So I'm not telling you to go and buy Nvidia shares, and don't go, please don't go and buy Nvidia shares saying, hey, Vivek talked about it. You guys know I sold off 2/3 of my position of Nvidia. I think it is overvalued, but it is continuously, stock continues to go higher. But I'm happy that I'm still holding 1/3 of my position in Nvidia. But it's a damn good business. Moat, capital allocation, profitability perspective. You know, they were growing revenue, secular tailwinds, less capital intensive. It generates cash flow. It checks all the boxes. Not only 1 year, 5 year, 10 year, 15 year. So good business. I would want to wait. Again, it's my thinking that it is overvalued right now because everyone wants Nvidia, and when everyone is clamoring for Nvidia or any goods, you can't get it at a fair price. But this is where you put these businesses on your radar list, on your watch list, saying, hey, if this falls down, I want to go and buy this. You do your study prior hand. Like I studied for ANET when on 5th of August, when the market went into tailspin for whatever reason, I picked some of those stocks which I have on my watch list, which are good businesses, right? I don't have a heart to buy Nvidia today, but I want to keep it on my watch list because it's a good business to buy when everyone is scared of it. And it's not just AI. It has been able to prove itself even in a non-AI world. So that's my thought on Nvidia. We'll see tomorrow what happens. Not tomorrow, 28th, what happens. Maybe a stock would correct. Who knows? But it's a good business to own. I don't know if it's a good investment right now. Okay. But I see a ELF. I guess we actually we just reviewed ELF. Was it last week or week prior to that in the stock review, like 5-minute review? Aditya said Berkshire recently added Ulta to its portfolio. Yeah, I think they invested $500 million. Why not? I mean, Warren Buffett is what, 93, man. He's getting some wrinkles now. He needs Ulta. Yeah. so he needs Ulta. Anyway, that's the you can sell put to help weak-hearted. I don't even know if on Nvidia, let's look at Nvidia. At what point do you want me to sell a put on Nvidia? Actually, yesterday was looking at maybe sell a put spread on Nvidia. I was looking at September expiration. So market is pricing in almost 10% move as of today. If you look at a market maker move, it's like $12 by end of September. Let's go back and look at on 30th August, right? It's almost $15 is movement is being, option market is pricing in $15 movement in Nvidia after earnings. And this is like as of Friday, right? Things could change on today, but as of Friday, $15 movement in Nvidia stock. From my perspective, I mean, I feel that even $100 is expensive, but what do I know? So yeah, you can sell a put or a put spread, but I don't have a heart to buy Nvidia stock right now. Maybe if it still blows the earnings, out of a roof, maybe I'll change my mind. I'll sell a put. All right. So what stocks did I buy or sell this week? Nothing. Let market fall. Let the market move into greed phase. or sorry, into the fear phase or extreme fear phase, maybe then I'll probably buy some stock. But yeah, but I did, of course, do options. And I think last week someone asked, how do on option side? So I do, you can see my option trades on the website. So I'll just share the link and I'll share you how it will show up. Oops, it'll come to members. Sorry. So this is, again, I don't have any, not doing any paid subscription, etc. So for once you register as a basic, which I know many of you did because you were attending boot camp. So all the recordings of the option boot camp are here. I know some of you asked me for the recordings. So all the recordings are here. The recent boot camp that we did, all the 13 sessions are here. What else you can do? You can see the recordings of these sessions. Sorry, this week I was late. I didn't update it the previous week, but I'll do it this week. I'll do both. So you can see the recording of our Saturday sessions out here. And you can see my trades 2 weeks prior. What I did. So let's say on 9th. This doesn't include my hedging because hedging is different. So you could see I sold ARKK 48 call. Why did I sell it? It was against my 44 short put. So basically made a strangle. ACHD, I sold a strangle. PayPal, I sold a call. TTD, blah, blah, blah. So you can go look at what I have done. Again, the idea is not that you should mimic it or replicate it. The idea is, the more important thing is to go through the comment and see the thought process, right? Then you can apply the similar thought process for your own trades if you want to. So just wanted to share. I do post it. You can see all my 2 weeks and prior trades. I think goes back up to 3 months on my webpage. Okay. Patience, how do you figure out how much the stock is expected to move by looking at the options? So if you're on a think or swim, right? So this will tell you the implied volatility, which will tell you what's the expected move. And good thing is TOS will show you right here on the right side. So I'm looking at 113% implied volatility, $15 up or down move. We don't know the direction. This is based on the option buying and selling, right? It's purely based on option buying and selling. The other is, as you get closer, you will see this MMM, which is called market maker move. So on the day of earning, you can look at here and see what's the expected move. So these are the expected moves on the right-hand side, what you see based on the options that I've traded on Nvidia for this expiration period for 30th August. So that's how I immediately said that the option market is pricing in $15 move. Okay. Hope that clarifies, patient. I don't know if other platform shows it or not, but Thinkorswim does. All right, so okay, let's talk about some stocks. PayPal. PayPal is no more PainPal. I know those who have been in PayPal. It's been a frustrated ride, right? It had its sweet time during COVID. So if you look at PayPal, was up like $300 during COVID and then gave all up, like a lot of other COVID darlings gave up, like Zoom and Square and all other Cathy Wood, ARKK and whatnot. PayPal also the same thing. So we reviewed PayPal last year, and then we did it multiple times when I said, hey, I want to focus on this one. When they changed the management, they brought in Alex Chris. And since then, every quarterly earning, I'll come and give you my update on what's happening. Or anytime they do another investor update. Most recent was around 6 new product enhancements. One of them was Fast Lane, which here are some tailwinds. What stock doesn't hit 52-week high just for nothing, right? So new product release, stuff that we talked about in January, February, after they did the investor update. First one was actually G8 and was released. It's called Fast Lane. And big thing is they actually partnered up with Adyen. So now, if you guys remember, Adyen is the biggest payment processor in Europe. They have almost 60% to 70% market in Europe. They are now trying to make inroads in US. But in any case, they have partnered up with Adyen, which is great news for PayPal. And Fastlane make it much easier for consumers to basically pay via PayPal on a merchant website. So in their pilot, when they ran, they actually saw 40% more conversions from browser to becoming an actual shopper through the use of Fastlane. In reality, the jury is out there because they're kind of rolling it out. But market is excited. New CEO, fresh blood, had came from Intuit, managing their small business sites. He understands the pain of small businesses. Changed the whole management team. Now they're not focused on just growing the users, which previous management was, but also increasing the engagement, which brings in dollars for the business. Other tailwind is from Apple. So there was a news from Apple 2 weeks ago, maybe, that they will be opening up their NFC chip, which is near field communication. That's all. So if you have to do it, Apple, to transfer funds to another phone, you can just tap a phone and the funds get transferred, right? Because that's the NFC chip that Apple has. They don't allow others to use it, but I think it was maybe last week or a week before that, Apple will be opening up their NFC chips so that other applications can make use of it. And I'm looking at Venmo. So Venmo is owned by PayPal. PayPal is like Gen Xers stuff. New kids nowadays use Venmo, right? So, and now one of a big bearish thesis was around, Apple Pay has eaten up all the markets, but now Apple is forced to open the NFC chip, not that they really wanted to, but they've been kind of dragged into the courts by governments. Like EU has forced it. So Apple, I think, is doing a preemptive measure to open it up for everyone. So once it becomes, PayPal start to make use of it, I expect the younger generation who's so comfortable with paying through phone, and it will become much easier rather than using Apple. You just pay through your Venmo just through by tapping the phone. So there are some tailwinds. Net, I think I'm a happy shareholder. And good thing is the thesis has worked out. So last time when we talked about it, was around $50. Now it's hit a new all-time high. Maybe it's too much too soon, I guess so, but it has actually performed. So that's on PayPal. Apple, marker calendars. September 10 is a new iPhone coming in with the iPhone 16 with iOS 18. Why can't they just have the same numbering? It's a extra load on the brain to remember what's the iOS version number is, what the iPhone version number is. But anyway, iPhone 16 with iOS 18. This is the release on which the Apple's valuation is hugely dependent, because, hey, this is going to have AI in it. And that AI is not compatible with the previous models. So you'll have to upgrade to other newer phones that should trigger a big upgrade cycle. If you look at, we looked at Apple's earnings review, their growth have stagnated. It's only, I think, last 2 quarters they actually had a growth. Otherwise, it was like negative. They were like doing less revenue quarter over quarter. sorry, year over year, they were doing less revenue for what, 5 quarters in a row. That was first time or maybe second time in the history of Apple. So this event could be, a big event from a company, from a revenue perspective, could trigger the next upgrade cycle. What I heard was there are like 600 million devices that are still 4 years old, and probably those may be looking to upgrade and are waiting for the phone on which your AI would work, which is your iPhone 16. Of course, they're gonna do another, some other stuff also, like watches and AirPods, but I don't think that's gonna move the market. Only thing that's gonna move the market is their iPhone sales, right? And how good the uptick of the new phones would be. Now, they're gonna, the release of the iPhone 16 will happen on September 20th. So it means in Q3, which ends on September, we'll have a 10 days of the new release. So we'll get to know some color of how those 10 days sales have been in Q3 itself. So the 16 will have a larger screens and new camera and all that stuff, but we'll see. And this is going to determine whether the Apple deserves a valuation that it has. It's all based on now this refresh cycle on iPhone 16. That's Apple. Let's look at another news, Uber. So Uber has partnered up with Cruise. Those who are in Bay Area would remember Cruise was an autonomous driving company. We talked about it when they ended up into an issue wherein one of a Cruise car dragged the passengers for 50 feet, and then they took off their services out of San Francisco. And there was a news, I think it was yesterday, that Uber is now partnering up with Cruise. So I hold Uber in my portfolio. We have talked about Uber. We also talked about the fact that Tesla robo-taxis coming in, could that disrupt Uber? That's a one big question mark on the existential question mark on Uber is, of course, it's a low margin business. We have seen on the numbers. But what if Tesla comes up with robo-taxis? How is Uber going to compete? The margins are already low, and now you're a competitor which don't have to pay the drivers. Well, how are they going to compete? So Uber has tied up with Cruise. Right? At surface level, this should be great news. So you guys tell me, what do you think? It's a good, bad, or it's ugly for Uber? I'll take a break to sip some cold coffee. What do you think? Is this a bullish for Uber? Bearish for Uber?
I think it's good news.
All right, any other comment?
But I believe Cruise said it's not just Uber they are tying with,
Bingo.
right?
So a few things. Yeah, I mean, number one is in this press release itself, it says we're partnering with Uber to bring benefits of safe, reliable, blah, 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 even to more people starting next year, following the launch of our own ride-hail service. So I'm like, and I don't know who's their PR person. But they have to write this line. They're saying, hey, we're going to compete with you. Then we will give you something that you want. So when I read this, I'm like, okay, so you are becoming competitor to Uber. In a sense, I hope that at least they're using Uber's software to manage the whole logistics of sending the cars where they need to go. Because this looks really bad. So that's okay. So it's not that Cruise. So when I first, because it's a Dara who's a CEO of Uber, he tweeted saying, hey, we're partnering with Cruise. And in his tweet, he had linked to this particular tweet. And when I looked at this tweet, I'm like, Oh, I'm not that bullish because first when I saw Dara's tweet, I thought it was Cruise will supply the autonomous vehicles and Uber will basically has its software and they'll basically get the cars from Cruise. And it's a win-win partnership, right? Cruise doesn't have a software. They don't want to manage, they don't want to get into, ride hailing service because, oh, you got regulations, you need to all that stuff, right? Uber already knows that. They have been around the world. They know how to deal with regulators. They've crossed all those hurdles. They have crossed all those T's. They have dotted all those I's. And my thought was that I thought that sounds good for Uber until I read this. I'm like, oh, so the cruise is also getting into ride hailing business. So they got to become a competitor to Uber. And like, I think was it Nyanka or was it Preet? I think maybe Nyanka who said it's not exclusive to Uber. So then to me now it seems like Uber actually entered into this partnership as a defensive move and not as an offensive move. Right? They are not partnering up from a position of strength. It is, gosh, if we don't do this, maybe robotaxis will kill us. Or if we don't do this, maybe Cruise itself will kill us. That's my thought. I could be 100% wrong. But my thought process was that Uber is not speaking from a position of strength. I don't know. That's what I said. What do you guys think? So we looked at Uber's, after the earnings, we looked at Uber and I said, hey, it's a ride-hailing business. The margins are very thin. And that's my concern is now if you're going to have these autonomous vehicle competitors, who's going to erode your margins further, what's there for shareholders? You can grow, but as growth doesn't come to me. What comes to me as a shareholder is after you paid up all your expenses, right? So that's I'm a little concerned about. So for me, I'm still 50-50. I don't think it's too bullish a news for Uber. They are not talking from a position of strength. Somehow I get that feeling. And of course, I could be wrong. Why do you say margins are thin? I mean, I'm not saying it. I mean, it's the data that says it, Morris. So we did Uber on last week. Yeah, we had a Q2. Let me just pull up the same sheet, right? So look at the margins. 2.98% operating margins. Because then you have to pay to the drivers, right? Look, go back like say 5 years. Okay. Wow. They didn't make any money in 5 years anyway. So yeah, they're it's a low margin, high volume business. So now if you have a competitor who doesn't have to pay drivers, that's a bad scene for Uber. I still hope that I'm hoping for a world in which Uber becomes the software provider, fleet management software provider, ride-hailing management software provider, your food delivery software provider, and Tesla's, Cruise, Waymos of the world become your car providers. And then they partner up with. That's the world that I want, that I am bullish on. If I want to hold my Uber thesis for long term, that's the world which I am seeing. But if that's not the world, and this is where the story part comes in, right? Right now, the Uber's investing thesis is based on that story. If that story doesn't turn out to be true, tough luck, right? So we'll see how this turns out to be, but I don't think that Uber was talking from a position of strength. What else? S&P is having rebalancing in September. And what are they going to do next? So these are the additions that they did in their prior rebalancing. In June rebalancing, they added KKR, CrowdStrike, GoDaddy. May, they added Vistra from utilities, blah, blah, blah. right? March, they added Decker, Supermicro, SMCI. What do you think gonna get added? I can tell you, if you spend time on Twitter or whatever, or X, these are the names I see. Palantir is, and maybe it's just because, hey, I own Palantir. I follow some of the folks who talk about Palantir, but I see every time rebalancing happening, folks say, hey, maybe Palantir will get added this time. Anyone else have seen on their social media what other folks are talking about? What could be a new additions to S&P 500 in the September rebalancing? What do you want? One stock from our portfolio that you want to get added to S&P 500. One, nothing. All right. So as it shows up in the question, most of the attention goes to the stocks that are being added to S&P 500. Which one is being added? Because once you're adding to S&P, you're going to have a lot of inflow, right? There will be demand for a stock by default because there is hundreds of index funds who will now have to buy Palantir because they track what S&P 500 does, right? Your retirement portfolio, you're gonna, your money is going into S&P 500 by default. You without you doing anything. So if that money going into S&P 500 and now your stock is getting included in S&P 500, there will be tailwind because now they have to buy your stock. So generally, a lot of attention is being paid on what are the stocks that are getting added to S&P 500. We don't pay much attention to what happened to those stocks that have been removed from S&P 500. What happened to them? Who tracks those? No one, not even interested in. I don't want to talk about the stocks that been booted out of S&P 500. There must have been horrible stocks. That's why they took it out at the first place, right? They wouldn't have been performing. Their performance would have been bad. So interesting study. It was an interesting article in Walmart, right? Wall Street, someone's trash is another one's treasure. So there's an interesting study around investors buying index fund cast-offs could have made 74 times their money since 1991. It actually performed better than S&P 500 itself. The trash that was taken out of S&P 500 actually beat S&P 500 over a long term. Right? Over, let's say, 60 months after the deletion, they beat S&P 500 by 25%. But if S&P was like 1, those were discarded, right? Bad stuff, it's the trash. Those were 1.25. So which was like, I'm like, I never thought about it. So that's an interesting study. So I think there is a fund or issuer that is coming up with an ETF. Again, I'm not saying go ahead and invest in this, right? This is the history is interesting. I would have never imagined, this particular data, but they looked at, let me see, what are the reasons? They start to do better. And so before and after deletion. So of course, before there were 2 reasons. Yeah. Okay, so they get hit twice. Number one, let's see, where was it? Jeez, I forgot to not mark it properly. Those that get dumped are also more thinly traded. Then a bunch of funds have to sell. Okay, so they get punished twice because number one is S&P nixes out the ones which are thinly traded, and then when the funds have to sell those thinly traded ones, because there's the market is small, they get punished even more severely just because of the market structure than their business would suggest. And I think that's why post deletion, it once this stabilizes, it actually tend to perform much better. So stock that get dumped by their nature are small and cheap. Between 1991 and 2022, deletions traded at 26% discount to S&P 500 for their P price to earnings ratio. All those value investors, PE folks, right? While the additions fetch 83% premium. So these are some of the stocks that just have been thrown out, but looks like they tend to perform much better than the overall index.
So sounds like, Vivek, interestingly, so what, these guys were waiting for the dip to stop once something gets thrown out of the index, and then they went in, whatever, 2 weeks later once it stabilizes or
So
something?
I think this chart shows that after the deletion, then after 60 months after deletion is where they've been able to perform it like 1.25. Again, this is the history, right? I don't know what's going to happen in future, but the idea is that once, and this talks about all the stocks, right? As an individual investor, we don't have a capacity to go and buy every stock that is being done. And hence, I don't think that we can even follow this strategy. That's why I'm waiting if there's an ETF, which is NIXT, next. I checked it yesterday. That ETF wasn't active yet, but I will want to keep an eye on this ETF, NIXT, which probably will track these that have been dumped. And maybe these probably tend to perform better. But I don't think as an individual investor that I will be able to invest in every company that is being dumped, because even in this whole mix, there'll be some which have become worse, might go bankrupt. There will be some which will recover and have become much better. On an average, it has done better, right? So that's why I don't want to bet on individual stocks, because I don't know which one will become stars and which one will actually be bad in any case. So, but it was an interesting article saying trash actually contains treasure. Something to keep an eye is NIXT. That's, if any takeaway from this is, it is NIXT. I want to keep an eye on when this gets launched. Not that I'm going to invest in it, but I do want to follow this to see what happens. All right. So that finishes this. Now the only thing remaining is earnings. But if you want to talk about something else, we can talk about that. We just hit our 2-hour mark, which is great. I think it's an anomaly that we've been done in 2 hours. But now I can talk about a little bit of Snowflake, or Zoom, or any other stock that you're interested in.
So I heard an interesting piece of news regarding Arista last week. Well, not heard. I was actually looking through their financials, and I saw their CEO sold about $6.2 million worth of stock in recently. So it's just an observation I made going through. It's an observation on my part, just going through their financial statements.
Yeah, so I had actually thought of talking about Arista today, and maybe we'll skip earnings, and if we can, guys can stay for half an hour, because now I'm thinking it's already 12. Should I do it? It will need 30 minutes to talk about Arista Networks. What do you say?
We should do it.
Anyone
I
else?
agree.
Arista
I agree.
or
Arista.
an individual stock? Arista. Okay, let's talk about Arista. As you guys probably remember, maybe I first talked about Arista 3 months ago, when we were going through these, looking at a good business, and I'm like, it checks all the boxes. I never knew about the company, but because it checked the boxes, I said, hey, you know what? I'm doing a on radar position so that it stays on my radar while I study a little bit more about the company. So I spent some time over the last 2-3 weeks to study a little more about Arista Networks. So why it is showing up on the left? What did I mess up? Oops. I don't know. White belt all the way to the left. Whatever. Doesn't matter. So let's talk about Arista. I am still not completely done with it, but let's see what I have. Yeah, so this was 724 is when I initiated the initial position. So it's exactly 1 month ago. Today is 8/24, right? And then I think we reviewed the earnings, and then I say a little bit expensive, but I'll be willing to buy more at 300. So I have a iron condor on it with a short put at, I guess, 300 or 320. And so I have basically, so if I have to buy it, I'll buy it below 300. And then I did a little more initial review. So let's talk about initial review. We have done this earnings review earlier, so I'll skip this. Let's talk about company and as a business. I think before that, I think there was some question around earnings. Sorry, I missed that. There was some question. Yeah, Morris, how do you prep for earnings release? What's your thought process? So, I mean, I'm just ready to, especially the companies that I'm tracking or that I hold in my portfolio, I just want to make sure what are the, of course, one is that there are some financial metrics that I want to track. Other thing is from a business perspective, there are some business KPIs that I want to track for those. So I do have a list, as the company becomes bigger part of my portfolio, start to add those business KPIs, right? Which I want to track. When the earnings come out, I will go and look through those financials as well as read their earnings release, see what they're on a KPI perspective, then see, if the business continues to perform, it's fine. I am not gonna buy or sell just based on because the earnings is coming up. I want to see how the business is, or the stock has just jumped up to 3-4%. If it is egregiously expensive, yeah, I might sell some, but generally I'm a lazy when it comes to selling. I learned my lesson hard way is, hey, if it is a good business and it is not egregiously expensive, just hold it and reduce your cost basis. So this week, I actually did a Google Sheet where I can track, did I go through the earnings letter? Did I go through the shareholder letter? Have I gotten all the financial data? And finally, did I update my investing thesis document? Yes or no? And I want to do it for every ticker that I hold in my portfolio, which is more than 2% of my portfolio, right? So that's all. That's my thesis around, what I do on earnings. So you look at it as a review period. Yes. I mean, if you want to hold individual stock and it has become a bigger part of your portfolio, you have to track how the business is performing. I don't want to outsource it to any financial talking head on CNBC. They'll come and talk about it without even knowing what the business is. I've seen many of them pumping their bags, right? Recently, I think when we talk about 13F, right? Altimeter Capital, Brad Gerstner, right? He come and singing a praises of Tesla FSD 12 and 12.5 many times. That's the first time when I heard about Tesla 12.5, because Tesla wasn't a big position in my portfolio, so I had never tracked it much. What did we find in latest 13F? He sold all his position. Altimeter Capital is out of Tesla. So follow the money. Don't follow what the people say. Follow the money. So that's why I want to do at least. And that's the reason why I also want to concentrate a bit is, I can't track so many companies. All right. So let's talk about Arista as a business, right? What are they? It's a data-driven cloud client-to-cloud network. So at the high end, overall 30,000 feet level, Arista is a networking company. Means they sell networking gears, switches, routers, software to manage those networking gear. So basically networking plus the software for that. No? The biggest competitors, the moment you talk about networking, which brands come to your mind? Which companies come to your mind? Come on, Cisco.
Cisco.
Right? Cisco, Juniper Networks. If you are in networking space, you might talk about Extreme Network. There are many companies. The biggest one is Cisco, right? And why not? Cisco has been an 800-pound gorilla in this business, have been around for decades. So the CEO of Arista Network was in Cisco for, I guess, maybe a decade or more. I haven't gone through her history yet. I'm just looking at the company history. But he came from Cisco, and the founders, one of the founder of Arista Network is also the founder of Sun Microsystems. Okay, so history. It started. I mean, I have a much bigger history. Let's go through that. Today, just morning, I just found this additional information. The company was founded and they launched their product in 2008. So founded in 2004, launched their product in 2008. So 4 years of heads down, just build the product, heads down, build the product, Launched it in 2008, which is called EOS. We'll go through what the EOS is. And yeah, so that's 2008 is when they launched, and they have been profitable and cash flow positive since 2010. Whenever we come across a company that has just come to the market and is GAAP profitable, means no more your adjusted shit here. It's purely GAAP profitable and cash flow positive. You could get a cash flow positive by doing sales, stock-based compensation. So we look at it, how much of that is. But that's what attracted to me a month ago when we were looking at Arista was some of those financial numbers. I didn't have the story then, but at the numbers were attractive enough for me to open up a radar initial position. Right? So what do they have? They have the core platform is what they call EOS. And I'm not from a networking background. I've never spent a minute working on networking, so I could be wrong. Anyone here from a networking background, anyone works in a networking company or had worked in a networking company? Who's going to be my quarterback? Because I'll be saying some things that are wrong. I want someone to correct me. Anyone from networking? Or in this? Okay. Come on, no one? All right. We'll see. Okay, so they have a software, extensible operating system. And of course, you have a hardware called switches, routers, and they build their hardware using the common silicon, not the very customized chips. What are the commonly available chips? So you can do it a little cheaper. Plus, then they have a software which they use to run it in more effectively. We're going to talk about it, how they do it. The biggest differentiation between how the other networking solutions like Cisco routers, etc. work and the way Arista works, at least this is what they claim, is prior to Arista, the way to know the health of your things in your network is you go and ask someone, you ping a device. Let's say there's a computer server, you ping it. Hey, are you okay? And computer say, yeah, this is called a heartbeat ping. Right? In tech terms, called a heartbeat. You ping the server, it says, I'm alive, good. You're another computer number 2, you're alive, good. You're alive, good. So basically, they go through a ping mechanism in which you round robin league or simultaneously you ping each of the devices in your network. And when they'll tell you, yeah, I'm okay, I'm good, right? What Arista and what EOS does is, instead of the pinging business, each of the component in the network, they basically continuously post their status. So I don't have to ask you, because the one issue in the ping is what happened to the system between two pings is unknown. Right? I asked you, how are you doing? You said good. 5 minutes later, I ask you. Of course, I think in a real life, it will be like whatever seconds. I ask you, how are you doing? It's good. What happened between them? We don't know. So instead of pinging, what EOS does, it stores the network state in a shared database. So it stores everyone, if there are 10 systems on the network, they store their state continuously in a database which is shared across the company, right? So that's the differentiation. Of course, I don't want to talk about what are the drivers behind this business, right? Hey, do you think there will be need of this business of networking solutions, digital transformation, artificial intelligence, right? So Arista has got a lot of stuff around artificial intelligence. They got a virtual assist, which helps you in managing your network. So there are a lot from a business drivers perspective. There are a lot of drivers. Hybrid work, because now earlier the folks were all coming to office. You got to put a firewall around your office and still be secure. Now there are folks working from anywhere, from office, from their home office, someone working from a beach. But how do you secure all that? Someone working on a cloud, someone working on a Wi-Fi, at access points. So there is a lot of a need for solutions that help you to secure, the devices, even if they are not in your office network. Zero trust networking, right? Which means I don't trust anything. Every time you want to access something in my network, you have to re-authenticate itself. This concept was popularized by Zscaler. So prior to this, the way companies will secure the network is once you're entering, it's like equivalent of once you're entering into a building, you show your ID and you're getting in the building, then you can go to any conference room, you can go to coffee room, you can go to any cubicle. Things have changed. So that equivalent was, I have a firewall across my network. Once you're authenticated, approved by a firewall, you are inside my company's network, you're good to go. Nowadays, that is like an old tech. Zscaler, Cloudflare, they all have moved on to something called zero trust security. Means I don't trust you. Great, you showed your ID, but hey, you want to access conference room number 1, you have to re-authenticate yourself. You want to go to coffee machine, you have to re-authenticate yourself. This is zero trust, right? So all of them have moved over there, which means, because in a previous case, if someone breached your firewall and got in, they got access to everything. In this case, access is determined by each individual level, just like Apple is, a bit. I don't work for Apple. I've never worked for it. But if you work for Apple, Apple doesn't trust anyone. They're so secretive. You can't go into every conference room in an Apple. You can't even get into some floors in Apple. Because, and similarly, look, Arista is also getting into this zero trust networking. What do they sell? Right. So there is a lot of tailwinds because AI will continue to have a demand for faster and faster internet, not just faster network, but for you to move huge amount of data, because which you will need to run your training models, it has to be way, way, way faster. So, and the only way data moves is through these networking gears. Even though we don't talk about it, it's not a sexy part of a tech company because it's a plumbing, but it's, just like the chips. Nobody used to talk about chips until Nvidia came into the picture. Right? It's a plumbing. Right? You don't see a chips when you buy a computer. All you see is a nice software. So, but now the chips are back in vogue. Similarly, networking is the plumbing of moving your data around, which you will have to move a lot if we are talking about AI. So what do they sell? They have solutions around core data center, cloud, and AI networking gear, right? Things that get into your data center, or if you're a hyperscaler, let's say Google Cloud, etc., you need to have the faster networking gears. Other thing they call it cognitive adjacencies, means basically your campus to secure a university campus, secure a stadium, those campus-related networking, wireless systems, etc. Third is their network software and services. So these are kind of a hardware, right? Switches, your routers, your wireless routing system. These are like a hardware stuff. And then they also have a software portion, which is network software and services called, let's say, Cloud Vision. Cloud Vision is a subscription service, right? So they have basically they use a to manage your network end to end. You can use Cloud Vision. So this is how I envisage this, right? Now all the devices on the network is putting their status into a shared database. How do you visualize it? Right? You need a software to visualize something that is going wrong, right? Hey, this hasn't pinged for so file or whatever. So that's a Cloud Vision, which will give you those capabilities. You may infuse AI in it so that you actually figure out the predictive maintenance before the stuff has gone bad. Before your router shuts down, you'll get to know that it's not really performing well. So maybe it's time to take it out and replace it with something else, right? So they sell Cloud Vision as a subscription service, or you can have it Cloud Vision as your on-prem license. They have a care service, right? In which it's like a customer support, enhanced extra premium customer support, right? They got a DANS monitoring fabric, which is your multi-tenant monitoring, right? I guess that would be your monitoring across. So multi-tenancy comes in a different, I'm getting into the tech side, is if you're running, let's say Linux, and you're running multiple tenants or the host on the same machine, and you want to know the health of that or monitoring that, right? So they have something called DANS. They have got Agni, which is Arista Guardian Network Identity. This is more of an identity solution, right? So expanding a little bit beyond just the basic networking. This is sold as a subscription license. They've got a network detection and response. Now, companies like Qualys, companies like Palo Alto Network, companies like SentinelOne, CrowdStrike, they all do NDRs or XDRs, right? Extended detection and response. Again, those, Arista and NDR analyze billions of network communication to autonomously discover, profile, classify every device, user, and application across a perimeter, means across a network, your IoT devices and cloud networks, everything. And it will tell you, is there something that could go wrong here? Of course, Cloud EOS that we talked about, which is they sell it through Amazon, etc. So let's say if you buy Amazon's EC2 for their compute, right, or AWS services, you could actually use Cloud EOS. And the last one is they sell as a support, right? Post-contract support. Now you bought Arista Network, you're gonna have a maintenance support for it. So not only that, which is a pretty standard practice when it comes to selling enterprises, you sell your product or software, and then you sell a support along with it. So nothing specific here. But these are the products. They got a set of products on the hardware side. Then they got a set of products on the software side, which is majority is subscription. Some are licensed also. Now they're moving, the new extension that I talked about is on the NDR. This is the new stuff. They actually did an acquisition to move into this space. I'll skip the details of EOS, skip the philosophy side. So now looking at it from an architecture perspective, one thing which I liked on the architecture, everything was that they have one set of code base across everything, which makes your operations or cost of operating and enhancing is way cheaper. I would spend time on software. Multiple code bases makes hell, your maintenance as hell, but they have only one set of code base. So architecture is still the same. Basically, they collect all the data, their EOS, collect all the data from your internet, from a data center, from your external campus, from your public cloud, if you have a AWS, from your WAN, if you've got branches, you've got edge devices, all get collected, put into one big data lake, which they call is that a network Arista EOS network data lake. And then they use AI, ML models, etc., for to tell you, to give you insight. Again, the biggest differentiation is each of the devices post their status, and then they just basically harness that data. What do they have a competitive strength or a moat? It was purpose built for a cloud networking platform. Cisco has been around, but when Cisco was there was no cloud. So Cisco's gears were built for on-premise managing of servers, etc. Of course, once the cloud became prevalent, every company will start to migrate or modify their services, hardware, software to work for a cloud. But there's a big difference between building ground up for a cloud versus modifying your existing stuff to suit your cloud. From a management perspective, from your prioritization perspective, it's a huge difference. Good thing about Arista is it was purposely built for being ground up to address the cloud scenario. So they didn't have any old baggage, huge baggage that they have to carry for their on-prem stuff, right? From my perspective, if I look at it, ANET is a zoom to Cisco's WebEx. WebEx has been around for years for your meetings, virtual meetings. But which is much better? Zoom is much better. Okay. Broad-based and differentiated portfolio. They use multiple merchant silicon architecture, the default ones, and which is also open source. So they get the benefit of open source community. They don't use ASIC, which has become very specific to your own application. ASIC means application-specific integrated circuits, right? So then you can't innovate faster because it's been built for your specific purpose. Rather, I would use the ones which being innovated much faster and control it via using my software. Single binary image software. This is what I was talking about earlier. They have only one image of software which have their feature consistency across your portfolio products, rather than you trying to maintain various different lines of code for different type of customers. It's much easier from an operations perspective. A few other things I found. It's a seasonality in the business. They operate on December 31st year, typically have a lower sequential in the first quarter of each fiscal year. So if you're reviewing this quarterly report, first year is generally low. They partnered with Jabil, Samsung, Flex, and Foxconn. They don't manufacture their own routers. These are the manufacturing partners. So after COVID, it has become much more important to start to pay attention to these, because our supply chain could go haywire. Right? They got 4 distribution centers, and they work with the Broadcom and Intel to create, basically have the chips for themselves. Competition. I've gone through many, companies' annual reports. Arista actually does a good job by naming the competitions through names, right? Other I've seen, they won't give their names, right? They'll tell you these are, there are many players, there are big players, and we're a small portion, or we have only 10% of a market. But Arista does a good job of actually naming their competitors. Of course, in data center campus networking, you got Nvidia, Extreme Networks, Dell EMC, HP, Juniper, AI, you got an InfiniBand and NVLink. Network detection, you got a Cisco, Darktrace, Extra Hops, so on and so forth. I didn't find any, they didn't list on the Zero Trust because maybe that's new. And I was reading the annual report of last year. Probably they'll do it. Management team, we already talked about it. Other Jayashree Ulal, she's got 3.15% stake. Compensation, CEO gets performance RSU and normal RSU. Means half of our pay is based on. And one good thing I like about this, I got to look into the proxy statement, is a lot of their compensation is actually based on the performance. Right? And they actually laid out the metrics. Whether you like the metrics or not, that's different. But what I liked is they actually laid out the metrics saying revenue growth plus adjusting operating income plus adjusted gross margin. That will determine your performance RSUs, which is, I'm not a big fan of adjusted numbers, but it's better than, not sharing this information or not having defined metrics, right? What are the risks? Huge risk. And this will hold me from making it a big position is 2 customers account for 42% of the revenue. So, which is Meta and Microsoft. So if Zuckerberg and Nadella, if Jayashree Ulal pisses them off, it's doomed. That's a huge risk. Number 2, the bigger your customers are, they'll extract a lot of favorable terms. Your negotiating power will be very less when you're talking to Meta and Microsoft. What I still have to maybe go back and look at last 5-6 years of annual report and see what was it prior. If it is actually concentration is coming down, then that's a good sign. Right? That is what I would want to see. If it was, let's say, 70% when they started or 80%, and then it has come down to 42%, great news. But this is one area where I'm concerned about it, that 2 customers constitute 42%, right? And if they don't like you, or if these 2 customers are big customers, right? Any of your competitors will be willing to bend backwards for these 2 customers, right? And they constitute 42% of revenue, huge concentration risk. Hardware sale is still the biggest component. Sale of the switches generates most of the product revenue. Software is not big. I think there was a question. Right? Software wasn't a big one yet. So in hardware, you have a lower margin. Right? So third is, of course, supply chain risk that I already talked about it. They use contract manufacturers, so you'll have a global supply chain. So if we have a COVID, your supply chain gonna get screwed, right? So revenue, 85% is coming from your product, which means license of hardware plus software plus subscription. 15% is coming from your customer support, which is, I think, which is basically post-sale services, right? Which is, I'm okay with it. That's a general, I think I'm okay anywhere between 80-20. I've seen companies 75-25, which I feel doesn't get a good valuation. Anything 80-20 or more than 80%, I'm good with this. I have no issues. 80% revenue comes from US. That's where the majority of revenue is. What I also liked is R&D is the highest category of expense. Sales and marketing is only 6.8%. Right? So the goods sell by themselves. Probably these are the high quality goods, or the other reason is the 2 customers. I mean, you got 42% of revenue coming from 2 customers. You don't have to employ a huge amount of a sales and marketing team to fan out and work with 100 customers to replace those 2 customers, right? So, but what I liked is a lot more spending on R&D than on sales and marketing. They did stock repurchase also. I'll skip this revenue recognition. They did also have invested in other companies. Nothing on an audit that came out which is concern to us. So overall, I think the company is good. Let's look at the numbers, and then we'll call it done for today. All right, so Arista Network, ANET. Oh, come on, where did that go? 2. So it's few things which I still have to work on to finish my thesis is, I'll tell you that as well. So look at from a quality of the business. Checks all the boxes on high quality perspective. 60% gross margin that they are even with them being in hardware. 62%. 40% operating margin with the hardware stuff. So these are the numbers that I am used to seeing in a companies that actually sell software. So let's go back and look at 3-year number, 5-year averages. I really have to figure out, this seems to be an abnormally high gross margin for a hardware company. But in any case, right? It's a high quality business. Of course, it is expensive. You look at a PE ratio, average for last 1 year is 35, for 5-year 33. So it means probably you're getting mid-30s has always been the case. Right? And plus the Buffett rule, thumb rule, it's a great business to own. But pricing wise, if revenue growth, analysts are saying 17% EPS growth, 19% average over next 5 years. Let's say I'll do 18%. That's something. 300, 320 is a good price to pay. But from a business perspective, last 5 years, let me go back to 10 years. The more green I see, the better I'll feel about it. Except valuation. I don't see anything which is wrong. Or like 10, I'm looking at 10-year worth of data. So this checks all the boxes. That's why, I still like the business, and but the question is, could it be a good investment? That depends on the pricing that you're willing to pay. I'm willing to pay $300, right? So that's Arista. So I still not done with it. Few things that I still have to go through is AI Ethernet switches, right? So this is the new product line. So if it cools down, what part of our revenue will be impacted? I still have to figure out. Keep an eye on impairment of the remaining goodwill on a balance sheet. That might be inflating your assets. Just today morning, I got access to this making of Arista to know a little more about the history. I have to run it through the scoring sheet. As you guys know, I have a scoring sheet. Once I've done analysis, I'll run through the scoring sheet to see where it scores. This is just to do a comparison between, should I invest, if I limit amount of money, should I invest in stock A versus stock B? So I want to have an objective measurement. I think in case of Arista, I'm going to invest in it anyway. It looks to be a great business, but let's see where it scores in the scoring criteria. That's still pending to be done. Once I find more time, I'll do it. But I'm not going to wait until then. It's a good business to own. Is it a good investment? That is determined by what we are willing to pay for it. With that, that's end of today's session. 12:37. Took more than 30 minutes. Glad that you guys are still here. I can hang around for another 5-10 minutes if you have any questions, anything else that you want to talk about. Otherwise, have fun. Next week is going to be a great week. Mr. Jensen Huang, the Godfather. We all live in Nvidia world. Everything else is is just a dream. It's all Nvidia. 320 for ANET. Again, I'm not gonna do nickel and dime between 300 and 320. And if you are looking for, and I'm looking at this company for next 10, 20 years, should be fine. So I already have a position on ANET. I think I have a covered call on, I have an iron condor on ANET. So, which means if it falls down, I'll buy it at lower than, maybe my strike price is maybe a 325. So yeah, anywhere I think 300, 325 is a good, I'll be willing to add more. Welcome, Aditya. Couchbase thoughts. I've never looked at this company. Is Couchbase became public? My only concern with these companies, these are like single product companies, right? MongoDB, Couchbase. Okay, so it is public. So let me do this thing. Everyone else can drop off if you're not interested in this. Let me just create the same sheet for Couchbase. Okay, you'll have to give me 2 minutes, okay? Let me export the data. Oh, we don't, okay, at least I don't have the latest data for it. But let me see, whatever we have, we'll live with that. Add this here, and let's bring up, let's do Couchbase. Come on. Do you need a new computer? Let's move it aside. All right, so we got a base. Let's get some TTM numbers. All right, TTM refresh doesn't make any profits. Okay, let me get everything else. All right, let's look at. Ooh, I see a lot more reds. Okay, so it's all about story. Looks like it's all about story. Okay, done. Okay, so to me, it looks to be. Let's look at it. How do I can target? It's $190 million revenue, pretty small company. It's $190 million revenue, $900 million of a market cap. Good amount of, I mean, decent amount of cash. When did it become public? Maybe recently they have raised the cash from their IPO. 700 employees. It's just a story. Numbers are not good, but what I'm a little surprised is revenue is not even growing at a much faster pace. I can ignore your numbers if you can grow your revenue as gangbusters. It's not even growing revenue. Like 3-year CAGR, I'm looking at 20%. That doesn't excite me. 4-year CAGR, 20%. So show me something to hang on to it. Show me growth in revenue. If you can't make money, fine. Show me growth in revenue. You're not showing me growth in revenue either. Right? Maybe there may be better opportunities. I mean, give me something to hang on to it. Yeah, the numbers. So it's a story. I don't know about Couchbase. I don't know about the story behind it. But Sachin, if you know what kind of mode they have, it doesn't show up in the numbers yet. Right? If they really have a mode, they have a unique product, and they've been investing a lot in the product, then I expect at least the revenues to grow at a more than 20% rate if everyone likes to buy their product. It doesn't show up in the revenue there. So yeah, I'm not interested. Company has to do more to at least to convince me why they are worthy of my dollars. Not for me. Yeah, gross by because this is a software company, right? So you don't get paid by gross. What's your cost of goods sold for a software company? Almost nothing. You don't even sell a CDs, right? So COGS is, gross margin, even though it's a concept, I mean, it's more applicable for manufacturing or older industrial concerns. For a software company, I would want to see the gross margin more than 70%, 80%, right? More than 70% minimum. That is, I was surprised that Arista has 70% because it got a hardware component. So I don't do that. Cyrus, check. Hey, Cyrus, you missed the boat. We actually, when I did a stock review for a check was there, but then realized you were not there, so I skipped it. But I can bring that back up unless any other questions. Sorry, Sachin. Couchbase not for me until I am aware of some story which is still not showing up in their numbers. Okay, so let's do check. CH. Alrighty. Yeah, check. I don't know what I'll see. How many Excel sheets are open? Not too many. Let's close Arista. Okay. Check. Didn't make any profit. TTM numbers, not that great, so I'll ignore it. $683 million revenue and $230 million market cap. Wow. Market has given it up for debt. What? Okay, this is the reason. $683 million revenue and net income is losing $600 million. It's like, yeah, come and buy a goods from me, $10 good, I'll give you for, it's like buy.
Oh no, wait. So that net income there, oh, can you hear me?
Yeah.
So then net income, it's like because the stock went down so much that like they had to write off like their goodwill and stuff like that. So it's not actually.
So we'll see. So yeah, I'll come to that. I didn't expect that they'd actually done an acquisitions. So if they have done acquisition, then they might have to write it off. So I want to focus on operating income, right? So let's say, and that's the reason I will look at what the operating income is, right? So, but anyway, so you're right. This could be because of something else not to do with their operations. $600 million of debt, enterprise value. Yeah, this is showing up. The difference is showing up because of debt. $103 million of. Let's look at the quality of the business, right? It's a software company, 60-70% gross margin. That's fine. 4% owned by insiders. What are they doing for buying back shares? The operating margins average is last year. It's not average. Last year, 2023 operating margins were negative. They're not making any money. They bought back shares. What are they doing? Are they raising debt to buy the shares? I can't reconcile in my head. You should do share buyback if you have additional capital to return it to shareholders. To me, this looks like a window dressing. Okay, let's go back 3 years. 3 years operating margin average, 0.5%. Revenue growth is 4%. Neither you are growing, nor you are profitable, operating profitable. What are you look as a shareholder? I mean, what do you expect me from a shareholder? Yeah, I'm not interested. And they are doing a capex of like 34% on an average capex. They don't, I mean, what are they maintaining? I thought this is an education software company. 34%, because they don't have any operating cash flow. I think that's why it's coming up. The average is coming up. The ratio is coming up so high, right? Yeah, it's not a good business to own, right? Yeah, I have my concerns. The revenue growth only 4%. So yeah, if you're not growing revenue, you're a mature company. Then show me the signs of maturity. Where's my dividend? Where's my profit? If you are showing me a signs of a toddler, that is everything based on a future growth, fine. Then show me the growth. It's giving me neither. So I'm not interested. And on top of it, it is buying back the shares. I don't know what business it has to buy back the shares. It is just to artificially prop up the share price. Then I have nothing to do with that management anyway. Or they think that, hey, it's done. ChatGPT is like put a nail in our coffin. I know why Chegg share has gone down and why the share went up during COVID, because everyone wanted answers to their assignments. You go to Chegg and you can get all the assignments done. You know, you can get access to the books. They sell used books, online education, courses, etc. Post COVID, the first hit came to them after COVID when kids started going back to school. Then the second hit, which is the last nail in the coffin, came from ChatGPT. What the heck I need to go to Chegg? I'll just ask ChatGPT. So I think maybe they've realized that there is no way to salvage this business, and hence let's do the share buyback. That's the only reason I can think of why they bought back the shares. Because they're not making any money. They don't have extra cash. They have a debt on their balance sheet. Pay off the debt.
But would you say, looking at the free cash flows, that is profitable?
Free cash flow is nothing but profitability. So free cash flow, let's talk about free cash flow. Okay, so how are they paying their, so here's the story could be. Their free cash flow positive because they paid everything stock-based compensation. Now to avoid the huge stock dilution, they bought back some stocks. So all they're doing is playing a stories out here. Okay, so let me go back to, oops, not here. Where's my quarterly report? Okay, let's go to quarterly report. Whoa, convince me for it either way, right? 1 year, 3 year, which number look good to you? Look at the share-based compensation, 18.5. So now if you really want to look at the real free cash flow, which is not sponsored by share-based compensation, this is negative. They have been only once or twice they had a positive free cash flow, or maybe more than once. But so now I get the story. You have to conserve the cash to show free cash flow because the market is, hey, free cash flow. And suddenly I see a lot of growth companies changing the behavior, trying to act like an adult. To show a free cash flow, you don't pay cash to your employees. You basically pay stocks to employees. Stock-based compensation increases. Now, Chegg has done is to reduce the amount of dilution. You buy back the stocks. What a crazy stuff. Why are you window dressing it? So I don't want to touch this business. The management is window dressing. I could be 100% wrong, but this is what the numbers are telling me. Look at, 3-year CAGR. It's a speculation. Now, where the stock is. Okay, so this is one, right? I reviewed so many stocks, I don't even know what the stock trade at. Wow. Now it's just a speculator's play. Tomorrow, can someone come and say, I want to buy this company, which will make a company double? Who knows? It's a speculative play. It's a lottery ticket. Nothing. I don't say anything in the business. All right, guys. So hope, Cyrus, I don't know, did I disappoint you or give you enough but I hope I gave you enough information that you can make your own decision. Don't go by my decision. I'm a different investor, you are a different investor, but I just gave you my feedback on what I'm seeing. And again, I never owned Chegg, I never analyzed it as a company, but whatever 5 minutes I spent, this is what I see here. Cool. All right, I guess that's it for today. Thank you, everyone. Take a deep breath on on Wednesday. It is better to not even look at your portfolio on Wednesday if you can't handle the volatility. The granddaddy will be reporting results, and like I said, it could have a much bigger impact on the market than Fed had. But we'll see. We'll see what Friday comes in, and we'll meet you again next Saturday. All right. Thank you, guys. Thanks, everyone. Talk to you later.